Hi, this is Stephen from Share Navigator with some trading ideas on the SPY. So we haven't traded this, guys, for a while. So let's just paint the picture at the minute. Federal Reserve have kind of changed a few things since last Wednesday's announcement. Basically, the idea of interest rate hikes coming sooner rather than later is on the cards now. Now, when I say sooner, you're talking about 2023 still, so it's quite a bit away. But it's really the tapering of that bond buying program. That's really what people are looking at, because that would have to start pretty soon, almost within the next couple of months, in order for the Fed to be able to raise those rates by 2023. So it's not too far away either at the same time. So, of course, the markets have sold off a bit, but to be quite honest with you, I actually think the market has held up really, really well given what the news was. So you can see, like, it hasn't come off that much at all, to be quite honest with you. A big sell-off on Friday on the broad market index, but what I thought was very interesting, the Nasdaq only went down half the amount of the S&P 500. So that tells me there's not a lot of panic selling there just yet. But that's not to say it won't happen. So just remember, guys, what's happened to the stock market. It's done this basically on cheap credit. And that's the bottom line, on cheap money. And it's a massive, massive uptrend. And they reckon now that stocks haven't been priced to these valuations in over 100 years. So the warning signs are there. Central banks are clearly indicating policy will change at some point in time in the future. It's coming. And you would imagine that the valuations of equities will change accordingly with that. Whether that happens today or tomorrow, your guess is as good as anybody else's. But you need to be aware of that. Right now, the sell-off is orderly, not a big deal in my eyes, and it's come right back to this 50-day moving average. But I want to stress, guys, that it could get very ugly in a heartbeat if more and more Fed governors come out and say, we actually think interest rates are going to have to rise quicker than anticipated. Don't be shocked if you see something like that. And it would happen in a heartbeat very, very quickly. So you've got to be careful how you trade this particular market. At this moment in time, no need to panic. 50 days off in support. But if the 50-day gets broken, your next area of support is this 400 level here on SPY. So how could we trade this potentially? Just looking at two different trades at the minute. I'm going to give you the one that's least risky first of all, but is the lowest probability. And that's the 410, 400 bear put spread. So basically what you're doing here is you're buying a put option at the $410 strike, expiring on July the 16th, and you're paying out about $587 for that. So we profit when we buy a put option when the market falls or the S&P 500 falls. But at the same time, we're going to take a bit of risk off the table with that by selling the $400 put. So that's really the opposite side of this trade with just a lower strike. And we're going to take in $375. So the net cost of this trade here is really about $210, let's call it, right? So you're risking $210 to potentially make $790 if the SPY falls to $400. And we know that that's a key support area. We know if the market sells off a little bit more from here, it's likely to go down to $400. So it's not out of the question within the next 3 weeks. But at the same time, guys, the downside of this trade is if the stock market doesn't fall, you're going to lose your investment. So your investment in this case is $210 a contract. So let's say, for argument's sake, you did 5 contracts. You're risking $1,000 to potentially make, $4,000, let's call it. So the risk to reward is 4 to 1, which is quite substantial. But you've only about a 30% chance of winning in this trade. So that's the trade-offs you have to do with this. What I love about the bear put spread, I know exactly what I'm going to lose. If I lose, I lose, and that's it. You're going in knowing what you can lose. The next trade I'm doing is probably suits people with bigger accounts. It's more risky actually than the bear put spread, but the probabilities of being profitable are much higher. They're actually probably closer to 85% in terms of probabilities of winning. And that's where we actually just do the bear put spread, as I just said. This time, though, we sell another $400 strike. So in essence, we're taking in 2 times the 375, which is 750, but we're only paying out 1 on the 410 strike, which is 587. So our net income, we're actually taking in money in this trade, which is about $160 a contract. So we're getting paid up front to plan this trade, but our risk is increased because we now have a naked short put here at the $400 strike. So if the stock market falls below 400, in theory, we'd have to buy 100 shares of SPY, which we wouldn't do. We would manage the trade. So this type of trade suits people who, can watch the market, who can roll out and down their $400 strike if the market starts to fall. Because as I said earlier, if this thing gets ugly, it could get ugly very, very quickly. I think that would be actually a buying opportunity, because I do think we'll have another go at the previous highs before this market eventually starts diving, and interest rates start dropping for real. We're only really at stage one, this talk about tapering. I think you'll have a few hissy fits in the market, which will be buying opportunities. But it's when the asset purchases start happening, reducing, I do think that's when money is going to start flowing out of this market. But up until then, I think I'd see these sell-offs as buying opportunities. But back to this ratio put spread, I emphasize it's really for people who know how to roll out and down the $400 strike, that extra short put that they sold. And that will really help you, manage this particular trade. So the probabilities in this trade here are be a lot higher than the bear put spread. You've got three ways of winning in this trade. Option one is if the stock market doesn't fall, you'll make your $160 from the premium you took in. If the market falls to 400, that's your absolute ideal spot. You'll make your 160 plus the $10 valuation of this $410 put, which is $1,000, so 1,160 profit. But your break even is actually, the market could actually fall to 390 and actually 388.40, and you'd still be at a break even point. So at every dollar it starts dropping below 400, that profit gets eaten into until you eventually get to 388. Then after that you start losing money. And that's what I'm talking about. You would roll down and out to another expiry, that $400 strike. So two different strategies, two different types of investor. That's what we're looking at the moment. If we place either strategy, we will let you know. But it's important you understand for your portfolio what's right for you. This is Stephen from Share Navigator with an update on SPY. Thanks and bye for now.